Welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer of First Source Bank. Since the beginning of the year, we've seen the return of volatility to both the stock and bond markets. Both, in fact, ended the month of January with negative returns, which is fairly uncommon. So what's behind this increase in volatility and recent downward price movement? We'd say it's a case of the IFs, IFS, inflation, Federal Reserve, and stocks. Let's start with inflation. As the graphic comes up, you'll see this is inflation since the early 1980s. And you'll see on the far right-hand side of the graphic that we've seen this surge of inflation. In fact, inflation recently was reported at better than 7%, reaching levels that we've not seen since the early 1980s. Where it goes from here and how much longer it stays above 2% is the question that the Federal Reserve is asking, and has created a nervousness amongst investors in both stocks and bonds. Inflation that will stay elevated and likely last longer than desired is starting to become the base case for investors, which is a shift from even several months ago. F is for the Federal Reserve. In this case, we're going to talk about the Federal Reserve target rate. The Federal Reserve's tone has changed over the past several months, such as removing the term transitory, meaning shorter term to describe inflation, to a situation where they're going to actually have to address inflation. That includes quickly ending bond purchases, raising rates, which will likely begin in March, and shrinking a balance sheet that has doubled during the pandemic. The size and speed of interest rate increases by the Federal Reserve will directly impact stocks and bonds, and has already done so. We have seen it specifically in the bond market, where the 2-year Treasury has risen enough that it is already anticipating 3 to 4 quarter-point increases by the Federal Reserve. We've also seen it in a shift in stocks, a move away from growth stocks to value stocks. Growth stocks typically are impacted more by interest rates. Recent comments from the Fed have made the market uneasy, as investors may have underestimated their potential response to inflation. The third graphic adds in stocks, or S in IFS. Stocks have become more volatile. In fact, the volatility has reached levels that we have not seen since the beginning of the pandemic. Now, we've highlighted the last 2 periods when the Federal Reserve was raising rates and inflation was rising. So if you look at 2003 to 2005 and then 2015 to 2018, both times when the Federal Reserve started raising interest rates, basically equity markets went sideways for a period of time. Through a steady economy and strong corporate earnings, stocks overcame the concerns of inflation and higher interest rates and began to rise. We currently have a positive outlook on the economy, particularly in the United States in 2022, and believe that corporate earnings could set records. And thus we also believe that stocks will end up being a good investment by the end of the year. A strong understanding of the markets and the economy with a little bit of time and patience are the best way to work our way through the case of the ifs. As always, thank you for the opportunity to work with you and your family, and have a great day.